Hello, I'm Abhilash Narayan, investment strategist at HSBC. Welcome to the latest edition of India Brief, where we discuss our house views about Indian fixed income and equity markets. Now, the sentiment towards India has turned incrementally positive over the past month, driven by a combination of increased expectation for potential US-India trade agreement and the bounce in consumer spending over the recent festive season, which was aided by the GST rate cuts that were announced earlier in the year. However, economic data, especially the widening of trade deficit and subdued PMIs, point towards an increase in near-term downside risks. On a more positive note, the headline CPI inflation fell to 1.5% in September, aided by lower food prices. Now, we expect inflation to remain subdued over the next few months, which should allow the Reserve Bank of India to cut interest rates by 0.25% in the upcoming December Monetary Policy Committee meeting. So what does this mean for financial markets? Well, firstly, we are bullish on Indian local currency bonds. We view the current yield levels as an attractive entry point for investors. In our assessment, a potential reduction in supply concerns, upcoming RBI rate cut and potential open market operations, and a resumption in foreign investor inflows should push bond yields lower over the next 6 months, which means that investors have an opportunity to capture some capital upside in addition to the coupons on offer. However, we remain neutral on Indian equities. The sluggish ongoing earnings season just reaffirms our view that earnings growth continues to be a drag on Indian equity markets, especially in the light of elevated valuations and their low exposure to technology and artificial intelligence related themes. Foreign investor inflows are yet to return, and the recent surge in initial public offerings or IPOs is drawing up the liquidity that is being supplied by domestic investor inflows, and that means that the technical picture is mixed at best. Within India, we have a preference for large cap stocks, despite their outperformance over small and mid cap stocks since start of the year. From a sector perspective, we continue to prefer more domestically oriented sectors, and we are overweight on consumer discretionary, financials, and industrials. However, we think that the risk reward for healthcare sector has turned a bit more balanced, and hence we reduce it to a neutral stance.